Good evening, everyone. My name is Juanita Pinar. I'm the Acting Dean of the Faculty of Law, and it is my pleasure to welcome you all here to the public lecture of the Gys Steyn Chair in Financial Regulation. It is an annual lecture, and this year is the second time. So you can see our first row is essentially reserved for chancellors. The incumbent of the chair is Professor Johan Scholes, so we are also his guests tonight. We are immensely honored that our guest speaker is not only the governor of the Reserve Bank of South Africa, but he is also the Chancellor of Stellenbosch University. And therefore, a special word of welcome. It's lovely to have you here and that you could find time in your very busy schedule to spend the evening with us. A word of welcome also to the governor's staff and personnel. It's good to have you with us. We are very fortunate, as I mentioned. We have two chancellors. We have the chancellor and we have the vice chancellor. Daresh, it's lovely to welcome you here in the Old Main Building, and thank you that you will formally introduce our guest speaker momentarily. It's also very nice to welcome, even if it's only for tonight, our former colleagues, Professor Nicolas Smit, who is now the acting COO of Stellenbosch University, and Professor Richard Stevens, the acting Vice Rector, Learning and Teaching. Welcome. We also have deans of other faculties. It's good to have you here in our beautiful Old Main Building. We also want to welcome the trustees of the Law Trust, colleagues in private sector as well as in public sector. We have former Stellenbosch University staff here. We also have an international visiting scholar, Professor Helen Keller. It's lovely to have you here tonight. And then, of course, our own Faculty of Law staff and students. We are indeed very fortunate to have the opportunity to listen to and interact with the governor of the Reserve Bank on the theme of his lecture tonight, More or Less Regulation, Responding to a Changing Global Environment. It is a critical theme, not only at an overarching level globally, but also for us, South Africans living here in our country. We are living in challenging times, and amidst uncertainty and inflation and rising costs, it is crucial that our economic well-being is safe and protected at the highest level. And therefore, I find it quite striking that the Reserve Bank values, including accountability, excellence, integrity, respect and trust, and open communication resonate so clearly with Stellenbosch University's own values. Thank you, Chancellor, for taking the time in a very demanding schedule to spend your evening with us here in Stellis. We are also honored that the Rector and Vice-Chancellor, Professor Daresh Ramjuganov, will formally introduce our guest speaker. It is at this point that I hand over to you, Daresh, and wish you all a wonderful evening.
Thank you very much, Professor Pina. Good evening, distinguished guests, colleagues, friends, students. It is my absolute honor and privilege as Rector and Vice-Chancellor of Stellenbosch University to echo the welcome that has been given by Professor Pina to the second annual public lecture of the Gys Steyn Chair in Financial Regulation Law. Now, this lecture series has already established itself as an important platform for dialogue at the intersection of law, economics, and society. It is my particular honor this evening to introduce, as Professor Pina has already done, someone who is both a global leader in financial governance and very much part of the Stellenbosch University family. Governor Lesetja Kganyago has served as governor of the South African Reserve Bank since 2014, and in 2024 he was reappointed by the President of our country for a third 5-year term. Before becoming governor, he served as deputy governor of the bank and his career spans decades of leadership in economic and financial policy. He also plays a significant role in international financial institutions. He chairs the monetary policy, prudential and financial stability committees of the bank. He chairs the Committee of Central Bank Governors of the Southern African Development Community, and he co-chairs the Financial Stability Board's Cross-Border Payments Coordination Group. His influence extends across the globe, with past service as chairperson of the International Monetary and Financial Committee of the IMF. And yet, while his leadership is recognized internationally, it is also deeply valued here at home, because the governor is the chancellor of our institution. In this role, he embodies the values of leadership, accountability, and service that we seek to nurture in our students and in our scholarship at Stellenbosch University. It gives me great pleasure to invite you to join me in welcoming the Chancellor of Stellenbosch University and the Governor of the South African Reserve Bank, Mr Lesetja Kganyago, to deliver this year's public lecture of the Gys Steyn Chair in Financial Regulation Law. And if you pay very careful attention, he may reward you with an interest rate cut. Governor.
Thank you very much, Vice Chancellor, and for all of those protocols, because then I do not have to go through protocols again. I will just dispense with that. A good afternoon. It's always a great pleasure to engage with the students and staff of Stellenbosch University. I extend my gratitude to the law faculty for the invitation to speak with you today. Not sure that the other faculty that believes they own me is particularly impressed, but here we are today. So, I decided to title my lecture More or Less Regulation. And it was for a reason, and the reason is not hard to find. And it has to do with the fact that regulation has got to be proportional or have got to be optimal, and that becomes important for us. And in my capacity as the Chancellor of this university, I wish to acknowledge Mr. Gys Steyn for establishing the Gys Steyn Chair in Financial Regulation Law. In South Africa, we need more interdisciplinary academic work on financial stability issues to both inform policy and build stronger relationships with financial regulators and policy makers. I've been involved in financial sector policy making for close to 4 decades, both locally and internationally. Over this time, financial stability risks have continuously evolved, and financial regulators have on far too many occasions been too slow to identify and respond to them. As we have seen with the great financial crisis, regulators' inability to anticipate these risks clearly demonstrate the enormous cost of overlooking these issues. Today, I will address the global regulatory landscape and tackle the following 4 questions. Firstly, why is the financial sector subject to regulation? Secondly, how did we get to Basel III and what has it cost us? Thirdly, how are the risks to the financial system evolving? And lastly, how do we develop the necessary skills to manage risks effectively? To start with the first question of why is the financial sector subject to regulation. Consider a scenario where you arrive at your bank and you are suddenly unable to withdraw your savings because the institution cannot meet its obligations. An even more serious scenario would be a banking crisis occurring alongside an economic crisis like the one we experienced during COVID-19, where you not only lose your job, but all your savings as well. The goal of financial regulation is to prevent economic and financial crises by building a system we can all trust. This means requiring banks to keep a financial safety cushion to absorb unexpected losses while at the same time protecting people and businesses from scams, cheating, and illegal trading. The nature of the financial system is such that there are often long lags between when someone makes a commitment and when you find out if that commitment is really valid. If you go to a shop and buy fruit and the fruit is rotten, you will know within a few days, and you can go right back to the store and address the problem. But if you put your money into the financial system, in a bank maybe, or with an asset manager, you may only want it back much later, perhaps years later, at which point you could get a bad surprise that they are unable to repay you. At that point, there is often not much that can be done. The money is gone, the company is insolvent, and for you, it's a disaster. It is also often a social disaster because financial failures often lead to larger crises. In the equilibrium where everybody trusts the system, those resources help support economic activity. But in the equilibrium where trust breaks down, everyone rushes to withdraw their funds and buying power goes out of the hands of productive users to under the mattress. This helps illustrate why financial crises are so expensive. As Carmen Reinhardt and Ken Rogoff famously documented, banking crises are associated with significant declines in output and employment, with the unemployment rate on average rising by 7 percentage points. The real value of government debt also explodes. Financial crises are amongst the most traumatic events a country can experience. Financial regulation, thus, is meant to address these problems. Even though everyone acknowledges that regulation can be burdensome, we agree it is necessary because the problem of financial instability is so severe. Unfortunately, we do not always agree on how much to regulate. There is a pendulum. Regulation tends to tighten straight after a crisis, when safety is a priority and losses are fresh in everyone's mind. But then over time, the memories fade and the burden of regulatory constraints become more visible and deregulation sets in again. I have seen this pendulum swing back and forth several times in my nearly 40 years as a policymaker, and it is moving again today. The last big swing of the pendulum followed the great financial crisis of 2007 and 2009. That crisis revealed how decades of deregulation, particularly in the United States, had enabled financial institutions to pursue riskier activities with minimal and poorly designed regulatory checks and balances. This is what shaped the development of the current regulatory regimes. Banks did not understand the risks associated with new products such as mortgage-backed securities, and they did not have enough capital to absorb losses. To address these problems, Basel III focused on overhauling bank capital requirements. The goal was twofold. Firstly, to improve the quality of capital by prioritizing shareholder equity over debt. And secondly, to modify the required ratio of this high-quality equity relative to the bank's total assets. South Africa was not one of the countries that experienced a financial crisis during the GFC, although we certainly experienced an economic downturn. Still, the GFC experience clearly exposed the shortcomings of Basel II, and so we applied ourselves seriously to implementing Basel III. We did this in a rigorous way, with robust analysis and extensive consultations amongst regulators and financial institutions. In my role as Director General of the National Treasury and Deputy Governor, and now Governor of the South African Reserve Bank, I have personally dedicated a considerable amount of time to discussing the various elements of Basel III with colleagues from other jurisdictions and with local financial institutions. In common with developments in other jurisdictions, critics of the new regulations have argued that Basel III has imposed substantial economic costs, making borrowing more expensive and restricting credit extension. However, the most effective policy changes have some short-term costs that are ultimately outweighed by medium and long-term benefits. In 2024, we initiated a call for research proposals to assess the economic impact of Basel III's implementation on South Africa. Contrary to some expectations, the findings suggest only an insignificant negative impact on economic activity at the aggregate level, as many financial institutions met the higher capital requirements by using retained earnings. At a more granular level, some smaller, less capitalized banks and specific borrowers have been more affected, but the research seems clear that the adverse effects have been modest and localized rather than large and widespread. The analysis also reveals that banks increase their capital ratios not only to meet regulatory requirements, but also in response to other emerging risks. An example is fiscal weakness. When confidence in government debt deteriorates, it affects banks holding such debts. These factors, in turn, can raise borrowing rates and reduce lending, thereby amplifying the impact of any regulatory changes. It is important not to attribute all changes to regulatory requirements. The closures of Silicon Valley Bank in 2023, followed by several other banks, and the takeover of Credit Suisse by Union Bank of Switzerland, serve as a potential reminder that the current framework is not perfect. Poor governance and unsustainable business models cannot be offset by any sensible amount of capital. Regulatory systems must continuously evolve in response to emerging economic and financial risks. The challenge for us as regulators is that we often find ourselves in a reactive position, struggling to identify emerging risks due to the inherent complexity of the global financial system. This brings me to my third question. How are the risks to the financial system evolving? In the field of cancer treatment, you will find that for some cancers, the largest contributor to a reduction in mortality is not new medication, but rather the reduction of risk factors. A prime example is smoking. As the number of people who smoke has declined, there has been a significant decline in lung cancer cases and the subsequent need for treatment. When we consider deregulation, we must ask ourselves whether the risk factors with the potential to destabilize the financial system have diminished. My assessment is that these risk factors have increased substantially. Allow me to provide a few examples. Macroeconomic and geopolitical instability. The global environment is marked by elevated macroeconomic and geopolitical risks. The Bank for International Settlement, in its 2025 annual report, identifies the current historically high debt levels across many countries as a major risk to the global financial system. Similarly, in South Africa, we have also observed a build-up of fiscal risks. Meanwhile, global policy uncertainty has risen to unprecedented levels. This, combined with geopolitical tensions and economic fragmentation, undermines the global economy's ability to act decisively in the face of major economic and financial shocks. If we desire lighter touch regulation, we must first reverse the current macroeconomic and geopolitical trends. The world is living too dangerously for us to be dismantling our defenses now. The second risk factor is the emergence of crypto assets and decentralized finance. Cryptocurrencies, or crypto assets rather, stable coins, non-fungible tokens, and decentralized finance platforms make it challenging to identify beneficial owners and prevent money laundering and the financing of terrorism. The sustained growth rates of over 50% in some crypto assets suggest the formation of large asset bubbles. These impacts will be amplified by the growing interconnectedness between traditional financial systems and crypto markets, as well as the borderless nature of crypto assets. Although some jurisdictions, including the United States and the European Union, have passed legislation to regulate stablecoins, current growth rates suggest that the build-up of financial risks continue. Technological advancements and innovation present a double-edged sword. While innovations such as artificial intelligence promise to make financial services cheaper, faster, and more accessible, their reliance on complex and often untested systems creates new operational dangers. A failure in one of these core systems could trigger a cascading effect, threatening the stability of the entire system. And while financial innovation can foster greater competition and drive inclusion, it may also encourage increased risk-taking. Regulators failed to foresee how the bundling of high-risk subprime mortgages into complex financial instruments could trigger the GFC. Today, the financial landscape is marked by even higher levels of complexity. In this context, it is often difficult to clearly identify the vulnerabilities until they trigger a crisis. We are also confronted with risks associated with climate change. Various institutions have attempted to estimate their impact. The most recent scenarios from the Network for Greening the Financial System indicate that under a current policy scenario, the physical impacts of climate change, such as more frequent and severe extreme weather events, could result in global GDP losses of around 15%. Our own work shows that the South African banking sector's exposure to transition-sensitive sectors is approximately 35% of total credit exposure, which suggests a high vulnerability to transition risks. The Financial Stability Board's roadmap for addressing financial risks from climate change identifies 4 priority areas. Firstly, improving disclosure. Secondly, data. Thirdly, vulnerability analysis. And lastly, developing appropriate regulatory and supervisory practices and tools. The most recent progress update, published in July, indicates that while significant progress has been made, the work is still foundational in nature. In South Africa, we have already published guidance notes for insurance companies and banks on climate-related disclosure, governance, and risk management practices. However, our ability to effectively address climate-related risks is hindered by considerable data gaps and the unreliable estimates of their possible impacts. What is particularly concerning is that every year some institution provides estimates about the frequency and severity of extreme weather events expected over the next 30 years, only for us to realize a year later that these estimates underestimated the actual impact of the events. Efforts to achieve coordinated climate change mitigation should become a bigger focus. A final risk is the growth of non-bank financial institutions. These institutions play a crucial role in the financial system, yet often operate outside the regulatory framework. Their diverse nature, rapid evolution, interconnectedness, and interconnectedness with the traditional banking system, and inherent vulnerabilities such as liquidity mismatches and leverage present significant challenges to financial regulators. In addition, there are many other risk factors that justify more and not less regulation, including cybersecurity and money laundering risks. In the case of South Africa, the Financial Action Task Force grey listing underscores some of the gaps in our financial regulations. While there may be limited scope for deregulation, there is considerable room to improve regulation and make certain functions more effective. For example, risk weights assigned to infrastructure projects in Africa remain excessively high, even though their failure rates are lower than in other jurisdictions. Further, government bonds are still classified as high-quality liquid assets, even in jurisdictions facing imminent fiscal crises. Therefore, risk assessment must become more reflective of the current economic and financial environment. I will now turn to my final question. How do we develop the necessary skills to manage risks effectively? Different groups will make different contributions to financial stability. Academics, policymakers, and market practitioners all have different roles. Many of you here today are likely to be university-based financial regulation experts, whether your background is law, economics, or actuarial sciences. Your role as an academic is both unique and crucial in helping society navigate changing and often challenging environments. At its core, your responsibility is simply to educate individuals and conduct high-quality research. This work is absolutely fundamental to navigating the complexities of the regulatory landscape. Allow me to explain. Becoming a proficient regulator, like many other professions, requires a solid interdisciplinary foundation and the ability to think critically. Many of these foundational skills must be developed during university training. The rapidly changing financial sector requires regulators to continuously develop new skills, and training programs must adapt to these conditions. This begs the question, how many universities in South Africa offer postgraduate training in financial markets operation and regulation? The answer, regrettably, is not many, despite the financial sector being the largest in the South African economy. When it comes to research, its purpose is not only to inform, but also to hold financial regulators and firms accountable. It is a critical component of improving policy development and ensuring accountability in the regulatory environment. Sometimes, poor university research is used to justify flawed policies or to discredit public institutions. As we contend with a proliferation of misinformation, it is essential for the academic community to ensure its members adhere to the highest academic standards to improve policy making. In conclusion, the global environment has become more uncertain, and many of the critical risk factors for financial stability have intensified. To effectively navigate the modern financial landscape, central banks and regulators must embrace technology such as artificial intelligence for risk analysis, rapidly integrate climate-related risks into its supervisory frameworks, and enhance international and cross-sector collaboration to prevent regulatory divergence. We do not need deregulation. Instead, we can regulate more smartly, but the risk environment requires us to step up, not step back. The most effective policy actions are those that are informed by robust analysis and which are coordinated across policy areas, institutions, and countries. In this environment, academic institutions play a crucial role by providing research, holding financial sector regulators accountable, and protecting their independence. I hope my talk tonight had provoked you to explore new areas of research to inform the discourse that is undergoing with respect to whether we should have more or less regulation. Thank you.
Thank you very much. The Governor has very kindly indicated that he would take a few questions. So if there are any. Yes, at the back of the room there.
Thank you. Good evening, everyone. Good evening, Governor. Thank you so much for the lecture. My name is Nikom Giba, and I'm part of the G20 Youth Summit. And I have two questions, briefly. So the first question has to do with the banking system, or rather the regulation of the banking system in the age of AI. So we've seen in the past, maybe it's a combination of over-exuberance by the banking sector combined with the lack of good regulation from the regulators. We've seen bank runs and we've seen banking crisis. How is the governor or the Reserve Bank or other regulators thinking about potential crises that we may face in the age of AI? Things will be faster. Banking runs will be quicker, the magnitude will be higher. So a few comments on the regulation in the age of AI. My last question has to do with the communication between the South African Reserve Bank as well as the National Treasury. I mean, I think it was a few weeks ago, we saw a letter coming out of the National Treasury. The tone was rather abrasive and belligerent on the adjustment of, or rather the potential adjustment of the target inflation from between 3 and 6 to 3. Can you just take us into your confidence, Governor? How is the the communication between the SARB and the National Treasury. I mean, I speak as a market participant and as a South African, and ideally, we wouldn't really want to see a little bit of friction between those who are charged with fiscal policy as well as monetary policy. Thank you.
Okay. Thank you very much. Regulation of banks in the age of AI is always going to be a challenge. Any technology that evolves poses challenges. And AI was one, and I had talked about the other technologies such as cryptography, the emergence of stable coins, tokenization that we have seen taking place. And I want to give you this example, South African example from the 2002 banking crisis that we had. And so we were meeting 3 times a day, and we will get the supervisors to speak to the banks, and we get the returns of the state of every bank 3 times a day. And a week later, sitting in a boardroom, a member of our National Payments Systems Department walks in and says that, colleagues, something is happening. He says, what's happening? He says that over the past 3 hours, the banks have withdrawn all their money with this particular bank, and they are all running into these things. And we said, yes. He says, I see this thing from the National Payment System. The supervisors were stuck on waiting for the forms, and yet the data was sitting right there in the National Payment System, and they didn't bother to think that we should be speaking to the National Payment System. We have since moved on now. We are able to mine the data almost real time to pick up what is going on. So the point here is not to say AI is going to pose a risk. Yes, AI will pose a risk, but what would be the nature of those risks, and how do we respond to them? And one of the things that we ended up having to do was to see how we could use artificial intelligence as regulators and supervisors to monitor the emerging risks in the financial system. The big Wall Street banks are spending between $7 and $12 billion a year now on artificial intelligence. For context, the balance sheet of the Reserve Bank. The Reserve Bank has got capital of 20 billion rand. So that gives you context. So we can't go and spend like them. And the approach that we had taken was, could we be engaging as regulators globally and see what is actually happening, share knowledge, who has built what, and move on that basis? Now, the manner in which these artificial intelligence models are trained is that you actually need data. And data is the new currency. Who owns which data? I don't know if you think you own your data, whether you know. But these owners of data, with your mobile there, they are able to tell exactly where you are in Stellenbosch, and they can tell you whether, when coming here and you saw the billboard, whether you subsequently bought what you saw on the billboard or you didn't. That is data. Who owns that data? Because in training models, you are going to need access to those to that data. And it turns out that the data is concentrated amongst very few players. That's the first risk. The second risk is that the people who develop these large language models, the providers, are also concentrated amongst a few. And one of the things we had to do as regulators in the past 12 months was to look at what we had called third-party provider risks. Because we then turned out, we said no. In South Africa, we had found that the banking system only uses the following big three third-party providers. And so we go to a meeting with other central bankers and the BIS, and guess what? Turns out that the banks in every other country are using exactly the same third-party providers. And the question we had to ask was, what if one of them falters? What's going to happen to the global financial system? And how do you insulate the global financial system? If you end up working for a bank and something goes wrong with that third-party provider, I can tell you exactly what the answer of the regulators is going to be. It's your supplier, it's your clients which are at risk. We expect you to sort it out. That is what you will feel. So the regulated sector has to take cognizance of that. When my regulators go and meet my supervisors go and meet the banks, they go and they find that they are carrying big files like this. And they take time going through these files, and they take pride that they went through these things overnight, and by the following day they are ready to ask very difficult questions. We have been piloting with tools that help them to take an annual report of an institution and summarize it for the supervisors in a matter of minutes. And so it releases them from the menial tasks and get them to focus on judgment and posing the right questions. So it's a double-edged sword, this AI. It offers opportunity, it offers speed, and at the same time, it also poses risks. So that is what we are faced with regulation in the age of AI. You talked about banks. You can stretch these things to insurers too. And one of the things we have put is that the insurers have built all of these models. And I do not know if you had seen these things, but the climatologists around the world, they draw these lines that says this is a 100-year flood line, this is a 50-year flood line, which means that the floods will only come in 50 years or in 3 years, and the water will only rise this much. Problem had been that a number of 100-year flood lines around the world had been broken at least 3 times in the past 5 years. So they no longer make sense. You can no longer call them 100-year flood lines. So what happens? The insurers and their large language models all recalibrate, and they all arrive at the same conclusion. We will no longer insure climate-related risks, or we will only insure them up to that level. Check your insurance policy. You'll find that there is a very nice little clause that exempts your insurer from that risks. So that is what you face. The sub-treasury coordination around the inflation thing, I must take you into confidence. What I had said has been said publicly. So it's not like that I'm taking you into little confidence. And let me put it this way and say that the discussion about the inflation target in South Africa and the revision thereof is not new. The revision was done in 2001, and in 2001, the then Minister of Finance, Trevor Manuel, made an announcement that said, the governor and I have agreed to lower the target from 3 to 6 to 3 to 5. Some other country in Latin America got into trouble, looks like it is in trouble again, and decided not to repay its debt. The rent tanked and there was a shock. And the following year, the governor and the minister came back to the South African nation and says, we will revert to the 3 to 6 target, and at an appropriate time, we will lower the target from 3 to 6 to 3 to 5. Well, an appropriate time never arrived. Trevor Manuel moved on, Tito Mboweni moved on, and nobody remembered that at an appropriate time we must revise the target. And this was tabled in Parliament. If you go through the record of Parliament, the Hansard, you will find that evidence. All that it took is some MP to go back to that Hansard and say to the Minister of Finance and the Governor, sorry, you promised us that at an appropriate time, you will come back and with the lowering of the target. When is the appropriate time and why have you not come back to us? And so, what many people do not know was that at that time, Tito Mboweni and Trevor Manuel had also agreed that once we have achieved the 3 to 5 target, we will also subsequently lower the target to 2 to 4, but we will not announce the 2 to 4. So if you wanted confidence, that will be confidence. That is what in the archives of the Treasury and of the Reserve Bank. And so in 2020, whilst we were minding our own business, dealing with the crisis, the Treasury commissioned a macroeconomic review. As part of that macroeconomic review, they commissioned a review of South Africa's monetary policy framework. And they asked 2 retired governors who are academics. One is based at the Massachusetts Institute of Technology. The other one is based at the Peterson Institute in the US, to do the review. And in that review, they came to the conclusion that our inflation target is too wide, is too high, and that we should be looking at something like a point of 3%. And that was the contestation that was taking place. And as it happens, you know, the thing about you lawyers, since I'm in the law faculty, is that once the highest court has decided that is the law, right, it's done. The trait that I apply, that is economics, is that every time you say, this is my view and based on the data, this is the thing, I go and look for alternative data to prove that your view was wrong, right? That is economics. So if we just continue discussing in economics, we will never make a decision. That is why there are policy makers, because the policy makers will sift through all of those and say, here is the decision. And so we decided that since this debate is continuing, we will organize a big conference in February, March, titled 25 Years of Inflation Targeting. We had all sorts of papers from international academics, local academics, foreign policy makers, former foreign policy makers. We had that. And the conclusion was South Africa should be aiming for a target of 3%. And there was one odd one out who said, but if your competitors, being the US and the UK and the Euro area and whoever, are targeting 2%, why are you targeting 3%? That means that you are out of sync, you are losing competitiveness. You should be looking at 2%, but the consensus was 3%. So the MPC expressed its preference and says the target is 3 to 6. Within the 3 to 6, whilst the discussions are still going, we will aim for the lower end of the target. Clearly, that didn't go well, and you saw the contestation. And I had said, the minister and I will find each other. And when the analysts kept on coming onto it, I said to them, let's get something clear. The Treasury and the Reserve Bank are siblings. When there is sibling rivalry taking place, don't enter it. Because once the siblings find each other, they are going to start fighting you and tell you how bad you are. That is why you saw a statement, joint statement issued by the minister and I that said, we considered all of these things. The Reserve Bank has expressed its preference of aiming for the lower end of the target, and we will consider all of these things, and an announcement will be made as soon as is practical. So don't enter a fight of siblings. You will be left alone.
Well, I think you got a comprehensive answer. I think it's fair to say. I think we've got time for one more question, if there is. There's a question there, Philip.
I think we should say to them one question for all four of you so that they can be one answer, so that we do not do not hog the system. One question, no context, just ask the question.
Yes.
How material is the risk of impairment in South Africa of how?
Thank you, that's much better. Governor, I'd like to know, in your view, how material is the risk that South Africa's access to the US dollar is impaired in the medium term through correspondent banking relationships or sanctions, given our increasing political misalignment with the United States? And secondly, do you think that access to the US dollar still is synonymous with access to the financial markets in general?
Access to the US dollar. Yeah, let's take the other side so that
there was Vivian's hand is up there. Can you state your name, please?
Thank you, Vivian Levak. I head the Center for African Fintech, Innovation and Law at the University of the Western Cape. Mine is a comment, Governor. I currently supervise about 5 of your employees, and I think there's a space for better collaboration between SARB, my former employer, and our universities. And my experience has been with the PhD students that I'm supervising, that the level of critical thinking and their own ability to do the research, the internal research that you also require when you work at SARB, actually is elevated through the experience of actually doing postgrad programs at universities. And I think that our SARB academy is underutilized, and a more formal relationship between universities and SARB is something that could definitely be improved. And I speak from a perspective of having been at SARB for almost 5 years in 3 departments, and there's some work that I think we need. There's some opportunity for us to explore.
Okay. Pass the mic.
There's one more here. Here.
Governor, thank you for your address. My name is Liam Gillison. I understand from your address that you're pushing for more regulation, or just the exact amount of regulation that we're at now. If I had to press you for why we should have less regulation, perhaps, what would your response be?
And one more. Yes.
Good afternoon, Governor. My name is Scott van Niekerk. I just want the regulation to be enforced. Thank you.
Thanks very much, Governor. You're ready.
That's exactly why I prefer to speak to lawyers than to economists. Economists will be telling me about what would an optimal level of regulation be, and that's all they do all the time. They are looking for optimal, whether it's in regulation or it's in inflation or in employment. They are always looking for optimal. That's what they do all the time. So, but the lawyers are clear, enforce the regulation. So, what would the case for less regulation? Let me be clear. I just today focused myself on financial regulation. I didn't talk about regulation in general. There might be areas of elsewhere where you actually need to be relaxing a regulation. So I was talking about financial regulation. Yeah, we're talking about financial regulation. And the thing about financial regulation is that, you see, if there is a regulatory failure in the health sector, you would have maybe patients die, but it will cause a big storm, But it will not take time for people to correct the thing. There are cases in South Africa where regulation failed, for example, in the health sector, or where regulation had failed in the telecom sector. You can come in and you could correct it and so forth. When you have a failure in the financial sector, it imposes a cost on the entire economy. And one of the studies that we talked about here, where we said that the impact was about 0.3% or 0.4% of the impact of Basel III on the economy. There is another way of also looking at it. In spite of the imposition of Basel III, South African banks are still amongst the most profitable banks in the world. Okay? And we have got a resilient financial system, which means that they were able to cope with that. Think of it. It cost us about 0.3, 0.4% of GDP. Think of what happened in the advanced economies once they had the bank failure. The costs were in excess of 10% of GDP. So that tells you the proportion and why we needed to focus on regulation. And you would also realize, I didn't just say more regulation, I said smart regulation, which means that regulation has got to be proportionate to the risks that you are trying to manage. XAP and universities, we tried. For a long time, we have got a chair of monetary policy at some Gauteng-based university. And we tried to create one for financial stability. And there was a contestation amongst universities. And eventually it was given to some Cape-based universities. Unfortunately, not this one. But after a number of years, we came to the conclusion that we are terminating the chair. And our approach now is that we would go out with requests for proposals. How people put together those from different universities or whether they collaborate is another matter. And one of the things that when we did this request for proposals on the impact of financial regulation and the experience with post-crisis regulatory reforms, what we found was that the universities' researchers started collaborating across universities, but something even more striking was that the collaboration was not just domestic. It was collaboration between domestic universities and international universities. So we would not be creating new chairs, but we would rather have the universities collaborate across. And this university here have got to be congratulated because this chair on financial regulation is multidisciplinary in nature. And that's because when we have to regulate the financial sector, we need accountants, we need lawyers, we need actuaries, we need economists. And as it has now come to bear, we need computer scientists because we are now in the age of artificial intelligence and large language models and quantum computing and all of that stuff. And we need all of those skills. And so the kinds of people that we would be looking coming into the regulatory space have got to be people who have benefited from that kind of multidisciplinary collaboration within universities and across universities. Thank you very much for that. And then the last question had to do with the use of the dollar, which I'm not sure that I quite understood, and it also talked about access to the dollar. I must recall whether it was the US Treasury Secretary or the US President who said this year, the use of the dollar is a privilege. It is our dollar. But there was another US policymaker some 25 years ago who said that the dollar is the currency of the United States and your problem. And it has to do with the fact that the US dollar is backed by the largest bond market in the world. And so when people talk about the risk-free rate of return, they are talking about the US. And it doesn't matter whether the US is undergoing fiscal challenges or economic or a financial crisis, the world just keeps on seeing it as the risk-free rate. That's what we are faced with. The BIS, the Bank for International Settlements, say that the dollar accounts for, in any foreign exchange trade, the dollar is found to be one of the currencies in 75% of the global financial. So I don't need to remind you that if I ask anybody here what the exchange rate between the rand and the Japanese yen is, or the euro, or the Aussie dollar is, even if we are playing rugby with the Aussies, you will not bother about that. You are all focused on the rand-dollar exchange rate. So that tells you the dominance of the dollar. Secondly, Gita Gopinath, the former first managing director of the IMF, had done this work, where it's established that 65% of world trade invoicing is taking place in dollars. Even if the countries that are there have got their own currencies, they still get done in the US dollars. Thirdly, the dollar accounts for just over 50%, just around 50% of the special drawing rights basket of the IMF. It moves a bit, and so the dollar becomes important. So when you talked about access to the dollar, what has the approach been taken by many countries? The approach that countries have taken is to build dollar assets, otherwise known as foreign exchange reserves. And more than 70% of the reserve managers say that they hold the biggest proportion of their reserves in dollars. Since those statements that I referred to this year about it's a privilege to be in the dollar, central bank publications ran a survey and found that reserve managers are trying to find alternative assets to try and diversify, except that there isn't a lot to diversify into. And people talked about, well, could the euro be one such currency? And the problem is the euro does not have a big common bond market, and that's why you will find the reforms that are taking place in Europe are talking about not just a banking union, they are also talking about a savings and investment union, basically meaning a capital market union. So that is what you will find taking place. We have also built massive reserves. The point, though, is what we have seen is that even after you have built the reserves, it doesn't mean that you are safe. Ask the Russians. They have got massive dollar reserves, but they can't access them, right? So reserve managers are starting to look for alternative custodians outside of the US. So that's why I highlighted the issue of the geopolitical risks as one of the big risks that is going to confront us. Thank you very much for those questions, and thank you for the engagement.
Thank you very much, Governor Kganyago. My name is Johan Skols, and I'm honored to be the first incumbent of the Gys Steyn Chair in Financial Regulation Law at Stellenbosch University. This research chair concerns itself with various aspects of financial regulation as a prerequisite for economic stability and growth, and is the first of its kind in South Africa. Governor Kganyago has emphasized the pressing need for impactful teaching and research in the area of financial regulation, And the establishment of this chair is Stellenbosch University's response to this call. A little bit more about the chair later, but first allow me to say a few words of thanks. In the first place, obviously, Governor Kganyago, thank you very, very much for giving so generously of your time. I know it's a very pressing time for you with the G20 coming up, and towards the end of the year, things ramp up. So we consider it a singular honor for the chair and for the university that you made the time to speak to us, also as our esteemed chancellor. And I would also like to thank the members of your office who've been incredibly helpful in organizing this. Thank you very much. Then thank you very much to our Vice Principal and Rector, Professor Ramgujanath, for your words of introduction and for your unwavering support for the law faculty and our endeavors. We are delighted to have our rector here tonight. Thank you. Our acting dean, Professor Juanita Pienaar. Juanita, baie dankie vir jou ondersteuning. Thank you for your unwavering support for the chair and for me over the last 2 years since establishment. It is very much appreciated. Thank you to all of you for being here. Thank you to my colleagues in academia, practice, in the financial services industry, and regulators. I really, really appreciate your collegial support. Perhaps a particular shout out to my colleagues and former partners from Webber Wentzel who are here in numbers tonight, and I appreciate that. Annette van Tonder and the other people who made this function possible. Annette is my PA, and she juggles many tasks and many jobs, and I don't know how she do it, but in the famous or infamous words of Annelie van der Rooyen, hoe sê mens dankie? And then, if you would allow me a small personal word of thanks, my life partner, Zanta Hofmeyer, is here tonight, and she flew down from Johannesburg, and I appreciate that very much. And then last, but by no means least, the trustees of the Stellenbosch University Law Faculty Trust for their role in the establishment of the chair, and of course the Steyn family, whose very generous endowment made this possible. I said I would say a few more words about the chair. The chair addresses aspects such as the economics of the financial sector, models of regulation, regulation of different risks in the financial sector, and regional and international financial regulation law. But that's a mouthful, and one can't do all of that at once. My students will tell me that I do try and do that all at once, perhaps with more or less success. And one of my tasks is to create a knowledge hub around which more focused expertise may be co-opted as needed. The chair is indeed multidisciplinary, or aims to be, as the governor said, and it aims to provide linkages between various fields: law, accounting, economics, banking, governance, and risk management, as well as between various entities: regulators, financial institutions, law firms, exchanges, intermediaries, prosecuting authorities, enforcement, and academic institutions. Now, while no one person can be an expert in everything, and I certainly am not, I see my network in the legal, regulatory, and academic world as one of the assets that I can perhaps contribute to the position. One of our other focal areas is the monitoring of global developments in the regulation of digital currencies, open banking, blockchain, sustainable financing, the regulation of carbon markets, so-called ESG, and the regulation of climate risk management by banks and insurers, to which the governor alluded. We live in a global society, and our financial markets are largely interlinked. Financial regulation can no longer be approached on a parochial basis. As a chair and as a university, we commend the Reserve Bank and the Treasury for their work in addressing the financial risks from climate change. We were privileged to have your Deputy Governor here, Governor Fundi Chazibana, in June, and she spoke about the role that central banks play in the regulation of climate change risk. And following up on that, we had a colloquium here, which the chair co-hosted, on green finance and climate risks. So we are beginning to see that things are coalescing and people in institutions are talking to one another. Recent events such as the grey listing of South Africa in 2023 that you alluded to have affected the country's excellent international reputation for prudent and effective regulation, and this chair, as a hub of expertise, hopes to play a key role in bolstering our position through impactful research publications, focused high-quality teaching, industry-relevant short courses, thought leadership, high-level conferences and colloquia, and importantly, the development of a bespoke LLM course in financial regulation, of which the first two modules will be taught in 2026. We hope that the full LLM module will be authorized very shortly thereafter. So finally, then once again, Professor Kganyago, thank you once again for giving so freely of your time and expertise at this busy time, and your presence, and in particular, your words and the knowledge and the expertise that you shared so freely with us is very, very valuable. I've got a small, and I can assure you, modest token of appreciation, which I would like to hand over to you. The governor could have been a lawyer because he said I said token and not tokens, which is very true. Please join us in the quad for some refreshments, and once again, thank you very, very much for your enthusiastic participation and presence. Thank you.